Good evening, ladies and gentlemen. Professor Arvind Panagariya, Mr. Sanjay Kirloskar, Mr. K Ranganathan. I need to start this session with an apology. We thought we had sent the link to Professor Panagariya, but unfortunately, we hadn't apparently sent it. And my real apologies to you. We kept you waiting for half an hour. But thank you so much for joining in. And once again, apologies to you and apologies to all the delegates that we have kept waiting. But many thanks for joining us at the AIMA National Management Convention and for agreeing to do the session on curing the economy from COVID's effects. You have been forthright in your views about what is the right way to go about reviving the economy, and it is exciting to have an opportunity to hear your prescription for economic rescue and rehabilitation. Thank you, Mr. Kirloskar and Mr. Ranganathan, for joining this conversation. Ladies and gentlemen, the disruption caused by COVID has shaken the conventional economic wisdom and stirred a new reform drive in the government. To mitigate the economic disruption, the government has injected additional liquidity and credit into the financial system and liberalized the MSME and agriculture sectors. It is trying to help domestic industry by raising barriers against imports. It is also trying to attract foreign investment in manufacturing by persuading states to make land and labor available with minimum regulatory compliance. However, the policy response to the crisis has raised concerns that the long-term impact of the short-term measures. So what would be the right measures to take going forward? It would be great to get Professor Panagariya's view on the same. But before we do that, it is my pleasure to invite Mr. Sanjay Kirloskar, President AIMA, to conduct the session.
Thank you, Rika. Dr. Arvind Panagariya, former Vice Chairman, NITI Aayog, and Professor of Economics, Columbia University. Mr. K Ranganathan, Vice President, AIMA, and Chairman and Managing Director, CavinKare Pvt. Ltd. Ladies and gentlemen, it's a great pleasure to have you and a very warm welcome to everyone in this session. In this session, we will have a conversation with one of the leading economic gurus of our times, Professor Arvind Panagariya, Professor of Economics, and the Jagdish Bhagwati Professor of Indian Political Economy at Columbia University and former Vice Chairman of NITI Aayog. Professor Panagariya, a very good morning to you. It is a privilege to have you, and many thanks for agreeing to share your thoughts on rehabilitating our economy from COVID's impact. You have been very vocal about how India can be bold when others are afraid. As Vice Chairman of NITI Aayog, in the first 3 years of the incumbent administration, you shaped the policy thinking of the first Modi administration, and your opinion carries weight in the corridors of power. You've also had a say in global economic affairs because of your involvement with the World Bank, IMF, UNCTAD, and Asian Development Bank. Your ideas and work were valued by the UPA regime also, which conferred the Padma Bhushan on you in 2012. This is a wonderful opportunity to interact with you and learn from you. Thank you for joining us today, and a very warm welcome again to you. Ladies and gentlemen, COVID has rocked the world. It has made more than 25 million people or 30 million people sick and killed nearly 1 million. India has suffered heavily as its COVID cases have shot past 5 million and its daily infections have risen by tens of thousands since August. Our economy has shrunk by nearly a quarter during the April to June financial quarter. Private consumption fell by more than a quarter, while investment declined by nearly a half. Construction was down by a half, and the manufacturing drop was about 40%. Agriculture was the only bright spot with a 3.4% growth in output. Our government has tried to shore up the diving economy with a 20 lakh crore rupee stimulus, mainly made up of credit and liquidity measures. The government has also come up with the idea of making India self-reliant in order to boost local industry and jobs. India is trying to enter a quick fix trading pact with the US to source investment and technology and to boost exports. However, there are pros and cons of every policy choice, and who better than Professor Panagariya to explain to us what would work and what would not. This is going to be a freewheeling session. I will kick off by asking Dr. Panagariya to share his initial thoughts, followed by a few questions. I will then request our Vice President, Mr. C.K. Ranganathan, to ask a couple of questions. And I would then request the audience to post their questions to Dr. Panagariya, and we'll take that up during our conversation with him. So, Professor, I leave it to you, maybe your initial thoughts, and then I will follow that up with my first question.
Thank you, Mr. Kirloskar, and very pleased to be with you all. It's an honor to be invited to speak. I'll just take 5 or 6 minutes to give some initial thoughts because I think it'll be much better to leave much of the time for Q&A. So let me just first say that we already have the numbers now for April-June quarter, and the GDP fell by about 24%. Many of the analysts have sort of said that, interpreted this decline as a sort of continuation of the decline that was going on in the growth rate starting from the first quarter of 2018-19. And so, we had a declining trend of growth rate for the 8 quarters preceding the COVID. And so, these analysts seem to have taken the view that somehow, even absent COVID, we would have seen a very significant fall of the kind that we have seen. I think that's a very misguided view. Really, much of the decline is due to COVID, and that is corroborated by the fact that other countries that were hit hard by COVID have had similar declines in the April-June quarter. So if you look at United Kingdom, 22% decline, Spain, 22% decline, Italy, which was on this COVID on a little bit earlier, so even before perhaps the first quarter began, had about 18%. The United States actually is lower, 9.5%, but that's largely because of 2 reasons. One, the first round of or first wave of COVID in the United States was smaller one, where only New York State was impacted badly. And also the lockdown in the United States was not as severe as in India. Likewise, if you look at the sectors which have been hit hard, construction, transportation, hotel, manufacturing, mining and quarrying, these are sectors where the lockdown was much more effective. Agriculture, where there was virtually no lockdown, more or less kept growing on its trend value. Public administration fall was much less. Electricity, which flows on the wire anyway, again, didn't show a large decline. So the sum of it really to me is that the decline is due to COVID, and really getting the economy back to the original trajectory of 7% plus, which is where we were in the first 4 years of, 7.7% in the first 4 years of Modi government. That's where we need to go back. And the first thing we will need to do is to gain victory over COVID. And that, of course, means bringing the vaccine as quickly as possible. So one thing I've been pitching is that, I did some back of the envelope calculation just within 1 quarter, that is the April-June quarter. India lost easily, by even very conservative kind of calculation, about $125 billion. That is the loss we need to really avoid. And for that, I think, overcoming the COVID challenge is the key. And therefore, I think we need to invest far, far more heavily in the vaccine right away, because even after vaccine gets approved, it will have to be manufactured and it will have to be administered. So whatever it takes, both for manufacture of vaccine and for administering vaccine, we should make massive investment now. Some we have done, but it's not, scale is not large enough. We ought to go in with at least $5 to $7 billion worth of investment in 5 or 6 of the leading vaccines. Even if 2 or 3 of those don't pan out, and just 2 or 3 do pan out, I think it will pay off. Because remember, we are losing easily $1.5 billion or so every day that the recovery gets delayed. So that's my first prescription, what we need to, in terms of what we need to do. Once we return, and you can see the signs, as workers are returning, the recovery is happening. In August, PMI for manufacturing went up to about 52. Even for services, it went up in August to about 42 from something like, in the 20s in April. Electronic sales electronic item sales also rose up about in August 40% over their value in August 2019. So as workers return, I am personally confident that the economy will return to the 7% plus growth trajectory where we were. Now, in terms of a few measures, very quickly, I'll take maybe 1 more minute, which is I would still pitch for the RBI to lower the interest rate. I think we need that stimulus there. RBI should also intervene in the foreign exchange market to ensure that the rupee doesn't get appreciated, because we need the foreign demand as well. From the government side, we'll need some fiscal stimulus. I think infrastructure building acceleration is the key to that. Some transfers could be made. We can come and talk about that. We should also go much faster for bank recapitalization. Last time we have made a mistake. I think we were much slower to get there. We should get there faster. And finally, I think the government is going to need revenues because the debt to GDP ratio is going to shoot up. To avoid that, to at least partially, we need to privatize in a big way, as well as monetize the assets like the roads, bridges, transmission lines, ports, airports, etc. A lot of scope there to raise non-tax revenues, and that is another thing we will need to do. So that's roughly my sort of summary comments, and we can elaborate on some of these as we go into Q&A. Thanks very much, Kirloskar.
Thank you so much, because it's good to point out that other countries also are in a similar situation in the first quarter, that our decline is not this far away from other Western developed countries. And I believe that what you said in the last 1 minute is sort of a prescription as to how we could cure the economy from COVID's effects for the long term and making the economy more resilient. So, you have said that the Indian economy has the potential to grow at 10% annually for 2 decades after COVID. But the policy of import substitution could reduce that growth rate by 2%. Could you please elaborate on that? And, we'd also like to have your views as to how Atmanirbhar Bharat fits in the larger scheme of economic reforms and how it would change resource allocation and benefit distribution.
All right. So the first questions, there are 2 questions you asked about. One is about Atmanirbhar Bharat, and the first is about trade. They're related, but for the first one, in the history, there are only 4 or 5 cases where economies have grown 8 to 10%. You could start with Japan, but among the developing countries, really post Second World War, you got South Korea, Taiwan, Singapore, Hong Kong, China. I think those are the 5. Not a single one of those has grown without being extremely open and capturing the global markets, and for good reasons. You see, when you operate in the global markets, you take advantage of the scale economies. Because even for particular products, the domestic markets are not large enough. For instance, even take the automobile. Our scale today is far smaller, and the large number of small plants, and not large ones. But this becomes even much in other sectors. It's even more pronounced. Global market is about 17-18 trillion in merchandise exports and another 7 trillion in services. So you've got about $25 trillion market. That's where the big demand is. That's where, if you're efficient, then that's where you operate. Also, when you compete in the global economy, you're competing against the best. So you have to put out your best. Whereas when you compete in the protected market, what you're doing simply is that, you're keeping out any problems you have domestically. You're trying to kind of neutralize for that by keeping out the imports, making them less able, right? We fight, when we protect, we fight our disabilities by creating disabilities for those who compete with us. That's not the way. I think we should remove our disabilities, which means doing the reforms and bringing our own costs down, raising productivity. And that happens by competing, by learning from the best in the world, through adaptation of innovation, but also good management techniques, everything you do. So, it really, openness is extremely critical. So if we really veer from that, I don't think we can get to 10%. Nobody has done that, to my knowledge, anywhere. So now, how does that fit in the Atmanirbhar Bharat? Now, my worries on trade side, which I have often expressed, have had to do with something that already started. This has been going on for 3 years or more. This whole import substitution business, and Atmanirbhar Bharat to me is sort of unrelated to that. I think when Prime Minister introduced this, he was speaking to the larger Indian audience, meaning all the people of India, including particularly, especially I think in rural India, and so this was confidence building measure to me. This is a way of building confidence, that people that look, we should be self-reliant. We should not have to depend on. But that doesn't mean, even in our households, for example, when we are self-reliant, all it means is that, we don't incur debt, we don't depend on somebody giving us handouts. What we mean is that we earn our own living. It doesn't mean that don't exchange with anybody, even in the US, I'm self-reliant in this, only in the sense that, I pay my bills. But I'm not self-sufficient. I sell my services to Columbia University and then buy whatever I need from everybody else with the income that I generate by selling my services to Columbia University. It's the same thing, in effect. And what we want to do is to buy from whoever gives us the products the cheapest and sell to whoever gives us the highest prices. And that is done by simply being very open to trade. Certainly to me, self-reliance doesn't imply anything about trade being closed down. That was a separate process that was underway, which I would like to actually reverse as well. So that's roughly, where I come out.
Okay, because I think Atmanirbhar Bharat, to my mind, doesn't mean blocking everyone else. It means opening up, because otherwise we are not going to get technology. Our skills, our workers are not going to get upskilled. The technology that we need, we have to get from countries outside, and therefore we have to allow them into our markets as well.
Absolutely.
You spoke about global competition and trade. You seem to have changed your mind about India not joining the RCEP agreement after China's aggression on the India border. What kind of trading regime do you foresee in Asia with RCEP? And what kind of impact do you think it will have on India?
Yeah. So I still think that, it is not time for us to close any markets with respect to China. We have to continue trading. But what I have said is that, China cannot be trusted. And what that means is that, if we had actually gone into an RCEP kind of an arrangement and gotten much more integrated with China economically, because it is the PLA and the Communist Party which really call the shots, it will not stop them from using our integrated trade relationship against us, should that suit them strategically. So we don't want to be in that situation, but at the same time, there's no reason for us to sever the connection. What we ought to do is distance ourselves, and for that I have said, we should try to start off with free trade agreements, both with the European Union and the United Kingdom. Now, as far as Asia is concerned, the field is quite open. I think there has been some minister level talks between, say, Japan, Australia, and India. I think we ought to expand that process with the other ASEAN countries, also with South Korea, for instance. South Korea is a very vibrant economy. We ought to upgrade our trade relationship with South Koreans as well. We seem to be sort of, very caught up in this, that somehow we have not benefited from the free trade agreements that we signed with Japan and South Korea. My own reading is not that. I think, those agreements have done fine, and it doesn't, once you take into account the fact that all trade has expanded, and therefore our imports from these countries have expanded as well. but our exports have also expanded. And maybe they were not all equal and symmetric and so forth. But, the whole idea of free trade agreements is to be open. And to me, if we can, open up without any free trade agreements, so much the better. I mean, if we can go down to somewhere 5-7% tariff levels, or even lower. I mean, I'm free trade economist, so I have no problem if we go to free trade. That may not be feasible politically, but if we at least lower. So we have to do one or the other. I mean, either lower tariffs against everybody, or against some countries with which we have good political relationship, geopolitical equation is good. These are largely going to the Western economies, United States, European Union, and the United Kingdom, Canada, Australia, Japan. So, I mean, those are the countries. Then, if we are not going to reduce tariffs across the board against everybody, then let us at least do it through free trade agreements. So that I think is what I see. But there are plenty of countries, look, the global economy is vast. As I said, $25 trillion, and our share in it is not even 2%. So we need China about merchandise exports. China has a share of 12 to 13%. That's where we need to head. At least get 4-5% of that very, very large pie.
Okay. You're talking about trade agreements, and what I have heard recently is that you proposed that India sacrifice the interests of domestic manufacturing industry to strike a trade deal with Europe instead of sacrificing the interest of Indian farmers to do a deal with the US. I don't know how correct that is, but I'm a manufacturer, so I'm a little concerned with that. How do you see the Indian government going about making trade deals?
Yeah. Look, one thing, that's not how I put it. Okay. I simply said that politically, I personally don't think that our farmers will fail to compete. Yeah. So if we were to actually cut a deal with the United States, what I said was the US will not cut a deal without us opening up our farms, meaning our agricultural market to the US farmers. They will not do that a deal that leaves agriculture out, and that will also be contrary to the WTO rules, frankly speaking. And so that is where I said I personally think that our farmers will compete. I mean, look, and so also therefore, when I say that for example, we can open the auto manufacturing, I think our auto industry will eventually come out stronger out of it. Yeah. Look, protecting the industry doesn't mean that shield the industry from any competition, and it also does not mean that nobody will be hurt by it. The whole idea of competition, is simply that those who are inefficient are actually do exit, and that is in the overall interest of the country, and the more efficient ones get to expand. Yeah. And we expand our scale. So, as I said, global market, even in automobile, probably over $1 trillion worth of market, we haven't got even 1% share in it, largely because our auto industry has protected behind 100% tariff plus 100% plus tariff, has simply not become as competitive. So it just hasn't got that extra to compete. And also a lot of the foreign manufacturers have come in with very small plants, basically to get the domestic market. That doesn't make for an efficient auto industry either. So there's no doubt. The whole point of the competition is restructuring, continuous restructuring, with vibrant firms winning out, inefficient ones losing out. So that's the nature of the business. I mean, in my own business as academics, if we don't produce, if we don't compete, we go into oblivion. I mean, it is, and that's what brings the best out of us. That, if you really have to compete continuously, and we are judged not by what we did 20 years in the past 20 years, we are judged by what did we produce last year, what did we do last year, what is he going to do tomorrow, so that's what measures, and that's the kind of competition we need to institute. So, this, when we say protection, who are we protecting? The buyer wants to buy the product, the seller wants to sell the product. Who is being protected by the tariff? You're stopping, it's anti-protection if you think about it, So, and don't forget our own experience. When we started this liberalization, there was so much opposition in 1991. But look what happened. 2002, India's merchandise exports were just $50 billion. $50 billion. 9 years later, by 2011, 300 billion, sixfold. Nothing expanded more than our exports actually during those 9 years. Sixfold. I mean, even the economy actually, GDP did not become sixfold within that 9-year period. So, you know, this is a bit of this confusion that somehow our firms can do better if we keep the competition away, especially competition from foreign firms away. It's quite the contrary, actually. You know, if you look at it, overall growth, and remember that 9-year period, 2003 to 2011, we grew about 8.2%. That was that is the growth rate over a 9-year period that we have not repeated or ever done before either. So I don't think it's a lose-lose. It is a win-win, except that, yes, it intensifies competition, so everybody has to work a bit harder.
If you remember, the head of the so-called Bombay Club, Mr. Rahul Bajaj, exported 15 million bikes now. So, yes, you know, it was good for him. My own firm, we export to about 120 countries around the world.
Look at that.
And we own factories in Western Europe and America. And, you know, what it has taught us is that to compete on a global scale, your products need to be the best, your finish needs to be good, your products need to be reliable, and only then can you compete. It makes us better. Absolutely. If we face global competition.
Absolutely, and then the market is vast. You know, once you convince the customers, then there is no end. I mean, that you're limited only by your ability to expand. But as long as you can continue to expand, there is no limit to the market. You see, so there is no equivalent of the global marketplace in this sense.
Well, I've been asking all the questions. There are questions from the audience, and Mr. Ranganathan is also going to ask you a few questions, and I will have to move to go to the next session. But anyway, there are a few questions, and one is a very one question is as of today. He says stock markets went down today. Reasons are European countries are going for the next phase of lockdown. Markets overvalued, profit booking. What is your opinion, Professor?
Well, you know, stock markets don't reflect what is going on today. Stock markets look to the future. And so therefore it's very hard, but there is also a bit of speculation and all. You know, we have all seen the topsy-turvy stock market we have seen in the US in the last 2 weeks, right? You know, because these are complex markets. There were all kinds of call options that were being exercised or traded, and that also had their impact on the stock prices. But largely, I think, you know, stock markets reflect what is the future, and I think you know, from that perspective, our stock market generally has actually now begun to show up, right? A lot of foreign capital is coming in. And they are coming in. And remember, the foreign investment is really flowing into our country, including into the stock market. And that reflects the general confidence that the Indian economy will do well over the longer run.
Yeah. The next question is, what sort of adjustment should be made to India's monetary and fiscal policy to support the corporate ecosystem? Now, I don't know whether this is a trick question or who's asked this question, but your take.
No tricks for me. You know, I have straightforward. I'm a straightforward person. So no, I have said already that on the monetary side, you know, I would not be bogged down by inflation because supplies will respond. You know, a lot of in my reading, April-June inflation was higher to a considerable degree. Some of it was in agriculture, in the food inflation, but to the extent that it was not in food, it was also because of the very large supply shock. You know, supplies had shrunken. And, you know, a lot of people at that time were saying that the demand will become a problem. Obviously, demand did not become a problem, which is why your inflation remained 6 to 7% during those 3 months. But I think supplies are responding. Therefore, actually, the pressure on inflation will be down. I would pitch for cuts in interest rates. I mean, whatever and continued provision of good liquidity. I think that's something the Reserve Bank must do. I'm not an inflation hawk. I simply think that, keeping inflation below 4%, or, which often ends up translating, closer to 2% rather than 4 or 6. I don't go for that. I think 6 to 7% inflation we can tolerate, and it's good, actually healthy for the economy, because that's where the profits are all seen in nominal terms, and growth in profits is seen in nominal terms. And for the industry's confidence, a little bit of inflation is actually not a bad thing to have. So I lean kind of on a bit more liberal monetary policy, but I also lean on the RBI ensuring that the exchange rate remains competitive, meaning that the rupee doesn't appreciate, because at the end of the day, what you get for exports depends on what the exchange rate is, very critically. So that's very important, and rupee has appreciated in the last month or two a bit, largely because I think the RBI simply couldn't keep up purchasing the dollars that were flowing in at a very high rate. But it has to accelerate that rate of purchase of dollars to keep the rupee at a competitive rate.
Okay. I'll now request our Vice President, Mr. C K Ranganathan, to take over and ask a few questions. He will also be delivering the concluding remarks, and I'll be as long as I can be.
Thank you.
Any other questions from the audience, or you want to ask the last question? Then I'll take over from the audience.
No, if you have any questions, or there is questions from the audience as well.
Yeah, one question you can say, and then subsequently I'll take over.
Okay. So the next question is the new farm bill going to help the agricultural sector and support the GDP?
Okay. So to the first part of it, unqualified, yes. These are reforms that we have been, I have written for more than 10 years, more than a decade. And the origins of these reforms actually go back to Prime Minister Vajpayee and all, who had mooted the APMC Model Act, which never got properly implemented. So I think that's a big kind of plus for the farmers, particularly, who are given the option to sell their product not anywhere that they want, to whoever they want. And it also opens the door for contract farming, where farmers can get an assured price for the quality of the product, and they will also be supported for whoever they sign the contract with in terms of technology, seeds, etc. So big plus. Will it support the GDP? Now, one thing, it is something that's a bit of a uncomfortable thing to say and hear, but that is a fact. That as far as the GDP growth is concerned, agriculture is not particularly important anymore, unfortunately. You saw that agriculture continued to grow at 3.4% in this quarter, the April-June quarter, but it did not stop at all the decline of 24%. And that's because agriculture is less than 15% today. Agriculture cannot grow on a long-term basis, cannot grow more than 4%. You can take the average of the last, since 1950, we have the data, and that growth rate is less than 4%, 3.5% at the most. Now think about it, 15% share, and even if it grows 4%, that's a 0.6%, just do the multiplication, and it's 0.6% contribution to the GDP growth. That's the best it can do, even in the best of the times. So at the end of the day, agriculture is important for India only because too many people depend on it. Almost 42% of our workforce is in agriculture, and it should not be that way. I think, ultimately the salvation of farmers lies in becoming something other than farmers for more than half of them, not everyone, but more than half of them. One simple statistic which I like to point out: today, 70 million farms in India, 70 million, which are 48% of all land holdings. 48% of all land holdings, numbering 70 million today, are smaller than half hectare. Half hectare, I'm not even talking 2 hectare, I'm talking half hectare. Average size of these holdings is less than a quarter hectare, just 0.23 hectare. On such a small farm, you can double the farmer income, you can triple the farmer income. Can't go very far. They need alternatives. And this is where my pitch always, industry and services have to do a lot better. Medium and large firms have to come up, which have high productivity, which can then provide decent jobs, and the workers can therefore migrate to those. I think that's my sort of, perennial theme basically, but that's what you need. So agriculture really the reforms are a welcome thing because it distributes the agricultural income more favorably to the poor farmer. But as far as GDP is concerned, that's not going to make a huge difference. Not even 0.5% point. Not even 0.1 or 0.2% to the GDP.
Thanks.
Okay, thank you, Professor. Before I go off, I'll just apologize once again.
Not at all, sir. Not at all.
Not sending you the link for today.
Thanks.
Thank you. CKR, it's all yours.
Yeah, thank you. Thanks, Sanjay. Thanks, Professor. It was very this thing you have argued very well how the economy can bounce back, has the potential to bounce back to 7% GDP growth. I have one question to ask, Professor. The pre-corona, the market was already, the GDP was slowing down, the growth rate. It was at 4.5 kind of this thing, and which used to be around 6.5, 7%. Slowly it's coming down. Unless the reason for that is addressed, I'm not sure whether it will bounce back. Only thing we can argue is that the stimulus package itself will be making a significant effect, whatever has been given. Therefore, it will bounce back. So I just wanted to understand your point of view, because still auto, I'm not sure how far that will recover post-corona. Like that, many industries which are struggling. And at the same time, a lot of people's... am I there? Hello?
Yeah.
Yeah, okay. A lot of people, this thing in terms of sectors, a lot of sectors are affected. I'm not sure how far that it will come back in terms of economy bouncing back to the normal level. So that's the question. Real estate, everywhere. I think the confidence to invest. People are not yet. The businessman has to come forward to invest much more confidently. That is not there yet.
Yes. So excellent question. And that is the $1 million question, really. So let's separate the two things. One is that, yes, the growth rate for 8 quarters had been declining. Last quarter of 2017-18, FY18, we grew 8.2%. After which the slide down happened. For 8 quarters, it slid down, came to 3.2% in the last quarter of 1920.
Yeah, that's correct.
And now we are in this decline of about 24%. So first point to note is that if there was no COVID, the economy would not be minus 24%. Maybe it will be not 7-8% or anything, but it would have grown at least 1, 2, 3%. And normally 3.2% was already low enough. It would have probably bounced back by this time. So a lot of the current malaise that we see all around us, pessimism, is rooted in COVID. So that's one. Now, what was the fundamental reason that this slide down happened, right? And you are absolutely right that unless we address that slide down, to get back to, so if you look at the first 4 years which ended in 2017-18, March 31, 2018, those 4 years, the growth rate was 7.7%. So it was not something like 6% or something, it was 7.7%. It's close, almost 8% if you round it off. That's where we need to go back. And I think my own analysis and assessment is that the key factor behind it was really the financial sector. There was a lot of stress in the financial sector, and finance is so incredibly important. You see, finance is like water. It goes everywhere, and if financial sector is in stress, then it filters through the entire economy, and so that needs to be addressed. Which is why, in my opening remarks, one of the very hurried remarks, but one thing I said, we need to recapitalize the banks now, in anticipation, because we have said we will restructure the loans. So that will certainly delay some of the bankruptcies, and therefore it will delay the NPAs. But it will only delay. It's not going to stop them. So bankruptcies will happen, NPAs will rise up again. And what the big mistake we made, and it was, I mean, at least I was actually from within struggling very hard to get the government to address the problem. In the end, like every other government, NPA's problems never get solved quickly. They're always, governments are reluctant to move fast. We didn't, so 2015, when we did Indradhanush, we allocated the 70,000 crores to the recapitalization. And of course, the cleanup didn't even begin till 2017. The IBC, the amendment to the Banking Regulation Act, which then led the RBI to instruct 12 of the largest NPAs to go to the IBC. That was in 2017, mid to late 2017. So that was delayed, I think, and we paid for it. I mean, we heavily paid for it, because that then also spilled over into NBFC crisis. Banking NPAs spilled over into the NBFC crisis in the end. I think we ought to address the problem today. I think the government has announced something like 20,000 crores. That is equivalent to the 70,000 crores under Indradhanush in 2015. You need to go bigger today. Do it preemptively. Otherwise, the same credit collapse will happen. See, we reacted last time after the credit collapse had already happened in 2017. Early 2017, credit collapse had happened. That's when the whole action began. We should not repeat that mistake. So I think that is very critical. I agree with you. If we don't address that, then going back to that 7.5%, 7.7% is going to be a tough going.
Thanks, Professor. I think we have, though there are kind of this thing, people would love to ask questions. I think we have to close this session. Now it is 45 minutes. We have already delayed the session. Sorry once again. Apologies for that, Professor. So it's my privilege to conclude this amazing session. Professor Panagariya, it is a pleasure to hear you discuss the options to cure Indian economy of the ill effects of the COVID crisis. You have laid out the problems and the solutions in an extremely simple and cogent way. I am sure that our audience has understood the situation more clearly, and they appreciate the pros and cons, different approaches better now. I also had the opportunity to read your article on 11th September in Economic Times. I think that is some essence is what you spoke. You have more elaborately spoken here. I think I am very fortunate to get a much higher view. As you have been saying, timing and directing the stimulus is the key to reviving economy. The supply side has been given relief and booster shots to come out of the lockdown coma. Now, as the supply chains are beginning to function again, it may be time for a demand stimulus. It is important to bring demand back in time to absorb revive the production and accumulated stocks. Also, India has to rethink its trade and investment strategy. As we have been advocating, India must remain open for the necessary imports, because without imports, no country can build global supply chains. At the same time, India must build alternatives to import that are better and cheaper in order to increase its share of value addition. Domestic capacity is also necessary to avoid a repeat of the supply chain disruptions. Indian companies must treat a reprieve from foreign competition as temporary. They must use this wrinkle in global trade to become more efficient and innovative. In the longer run, the world will go back to the specialists and the lowest cost suppliers. The consumers' patriotism cannot be taken for granted. Ultimately, price is a measure of all these sentiments. Price and quality, I would add. India has a rare opportunity to compete with China for global manufacturing investment, and it must use its huge market with enormous growth potential as a bargaining chip. In the 1980s, a large number of global manufacturers rushed into India, even though they were not allowed ownership in India and were forced to form joint ventures with local companies. They saw a market of future, and they have not been disappointed. This is a different time and a different India, and the country is in much stronger position to bargain. This time, India has the advantage of a politically and economically powerful diaspora, and the country's intellectual and commercial prowess is rated very high in the developed world. However, the foreign companies with global supply chain must be made to feel that they will have a level playing field in India. Professor Panagariya, it has been a privilege to listen to you, and we hope that all you will grace AIMA platform in the future too. Thank you. So I thank our excellent audience for joining us in the session, asking some very important questions. Your active participation made this interaction even more lively. Thank you, and please stay with us for the next session. Thanks a lot.
Thank you, Mr. Ranganathan.
Thank you, Professor.
Thank you, Mr. Ranganathan.